Today, cryptocurrencies are back in the green as Bitcoin reclaims the $115,000 level. And Wintermute CEO weighs in on a new statement from the SEC that says certain liquid staking activities do not constitute the offer or sale of securities. Welcome to CNBC's Crypto World. I'm Talia Kaplan. Major cryptocurrencies and stocks are in the green today as investors analyzed the latest batch of corporate earnings following a negative session on Wall Street yesterday. Investors, of course, have been grappling with the potential impacts of President Trump's tariffs. As of noon Eastern, Bitcoin rose 1.6% and crossed back above $115,000. Ether climbed 2.5% to $3,665, and XRP crossed the $3 mark. Okay, let's talk about the top stories. A division of the SEC dropped a new statement yesterday saying liquid staking doesn't constitute securities offerings. Liquid staking is when a crypto holder stakes tokens on a blockchain and receives derivative tokens that represent those locked up funds. That allows the holder to transact with those derivative tokens while the original crypto remains staked and earns yield. Well, the statement out from the U.S. Securities Regulators Division of Corporate Finance says that liquid staking activities like protocol staking do not involve the offer or sale of securities under current law. It also says the offer and sale of those staking tokens don't fall under securities laws either. The statement was largely celebrated within the crypto community, but it's not an official rule or regulation, and not everyone within the SEC agreed with the conclusions it made. Commissioner Caroline Crenshaw issued a rebuttal yesterday, saying that some things are better left unsaid. She argued the statement from the agency muddied the waters and that it was based on a stack of factual assumptions rather than industry reality. Additionally, the footnotes of the update says the agency still reserves the right to deem specific staking receipt tokens as securities. Next, China issued a new warning about iris scanning devices. China's Ministry of State Security issued the warning about the potential misuse of biometric data by foreign companies, specifically those offering crypto for eyeball scans. Now, the warning doesn't specifically mention the crypto project founded by OpenAI Sam Altman, now known as World, formerly known as WorldCoin. However, it does appear to reference the project's orbs, which face scrutiny from several jurisdictions since the launch of those eyeball scanning devices. Several countries, especially in Europe, placed temporary bans on those devices, including Spain and Portugal. China's warning says that publicly reported cases have revealed that an overseas company, under the guise of issuing cryptocurrency tokens, scanned and collected iris information from users worldwide and then transferred the data source, posing a threat to personal information security and even national security. Now, we reached out to World for comment, but didn't hear back right away. All right, back to the SEC's update on liquid staking for our main story. Crypto World's Tanay Makil spoke with Evgeny Gaevoy, founder and CEO of crypto liquidity provider Wintermute. He breaks down what the statement means for companies like his.
Without getting overly technical, explain for the uninitiated to begin what exactly we're talking about when we talk about liquid staking and how that's different from regular staking.
Yeah, thanks. And first of all, thanks for having me. Basically, in a nutshell, liquid staking allows you to utilize the staking functionality of blockchain, all while basically maintaining access to asset, which is effectively a replacement for, like, for example, if you stake in ETH, if you use liquid staking, you effectively get a liquid staking token when you stake it. So you can effectively reuse it somewhere else. You can borrow against it. You can trade it. You can buy and sell it. You can do whatever you want. So basically, it allows for a lot more flexibility for people who use staking effectively, instead of just locking their tokens and be like waiting for some time to unstake them. They can actually further leverage the blockchain to basically do more things with it.
So we got this update from the SEC this week, which has now issued this guidance saying that liquid staking activities do not constitute securities offerings. Explain to me and to our audience what exactly that means for investors, and what types of investors this statement will be most impactful for.
I think partially it's for investors. So a lot of investors were hesitant to use those products because they were unclear whether those are securities or not. So it's primarily for the institutional types of investors who are just worried that they might be breaking some rules. But it's also, this statement is also very important for DeFi protocols, for exchanges that list those products, to basically continue experimenting, continue creating those products, continue listing those products, and basically allowing those products to be used by wide range of consumers.
So from here, what do you expect to see next in terms of product innovation? There are two parts to this, right? So I guess start with the ETFs and the funds, because I know that staking has been a big part, not necessarily liquid staking, but the staking element has been a big part of the conversation when it comes to the Ether ETFs. And then I do want to get to more of the DeFi and the protocol side. But for the ETFs, what are the implications going forward?
It's a great question. Basically, for ETFs, I think one of the big hurdles, and we as a market maker, we have been involved with a lot of ETF issuers on this. They have been hesitant to use liquid staking product effectively because they were afraid that maybe they would be securities, and it's one thing to have ETF on security, it's on basically commodity. It's another thing to have ETF containing a security. Now with this new status, they effectively, I think they're a lot more free to basically, instead of developing all the staking infrastructures themselves, to effectively lean on existing liquid staking products.
And you had mentioned that it's not just the investors, it's also the protocols and the DeFi space. So what, given this guidance that we have from the SEC, are you expecting to see differently on the innovation front?
I think we will see a lot of, basically a lot more of those products to be offered to, well, US people in particular, because that was another kind of unintended, well, maybe unintended, maybe intended consequence of a previous SEC regimes that basically a lot of those protocols didn't really want to work with US users in any phase or form. Now, generally, I'm just very excited that the current SEC is effectively sophisticated enough to basically being able to distinguish different types of tokens out there, and basically figuring out, okay, liquid staking is not a security. It's something that's just inherent to the blockchain. It's just a very natural thing for people to use, and very natural for investors to use as well.
So in terms of next steps, events, developments, what is sort of the next, or like the next couple things to watch from here? But whether it's on the regulatory side, are we looking for another step there from the SEC or from Congress that you'd like to see? Or on the crypto side, what's like the key thing to watch for you from here?
To me, the most exciting thing is basically kind of like the end game for those liquid staking products always was to ultimately, because they are kind of, for an investor or for holders, they're basically a superior, like if you look at Ethereum, for example, staked Ethereum products are basically a superior version of Ethereum. So the end game for a lot of those staking products is to replace ETH when it comes to trading. So we effectively can potentially hope to see that, I don't know, in 2, 3, 5 years time, we're not trading ETH, we're actually trading like a bunch of different staked ETH products instead, because they're just better, because they effectively accrue interest. They're basically superior products to hold trades, use as collateral pretty much in every aspect.
Okay, that's all for Crypto World today. We'll be back again tomorrow, and we'll see you then.